What is happening right now is much bigger than a normal crypto news cycle. Because when one of the world's most important trade arteries comes under pressure, everything starts to shift. And when people begin talking about fees, settlement, and even crypto payments, this stops being just a price story. This becomes a story about trust, energy, power, and the future of money itself. The Strait of Hormuz is one of the most critical choke points on Earth. A huge share of global oil and energy flows passes through this narrow passage. So when tension rises there, the impact does not stay local. It spreads into oil prices, shipping, inflation, financial markets, and eventually crypto. And that is exactly why this moment matters. Over the last days, tension around Iran and the Strait of Hormuz has pushed markets into a fragile state. Whenever this region becomes unstable, the consequences ripple far beyond the Middle East. Oil reacts, shipping reacts, markets react, and Bitcoin reacts too. At first, Bitcoin does not always behave like people expect. It does not automatically surge like an instant safe haven. In many geopolitical shocks, Bitcoin initially trades like a high-risk macro asset. If liquidity tightens and fear rises, Bitcoin can fall with everything else. But that is only the short-term reaction. The bigger story is what this reveals beneath the surface. Digital assets are no longer just speculation. They are entering real conversations about trade, settlement, and financial flexibility. And that changes everything. To understand why this matters for crypto, we first have to understand why Hormuz matters for the world. This is not just another shipping route. It is one of the most important energy choke points in the global economy. Massive volumes of oil and liquefied natural gas move through this corridor. That means when this passage is threatened, far more than regional politics is affected. It affects fuel prices, transport costs, supply chains, and inflation expectations. It even affects how central banks think and respond. When Hormuz shakes, the entire global system feels the pressure. And when the global system feels stress, capital starts looking for mobility, protection, and optionality. That is where crypto enters the conversation. The biggest significance is not that the whole oil market suddenly starts using Bitcoin directly. The real significance is that crypto even enters the discussion in a high-pressure geopolitical environment. That alone is a major signal. For years, crypto was seen as something separate from the so-called real economy, something speculative, niche, and disconnected from serious global finance. But when trade routes come under pressure, people start thinking differently. They start asking what can move instantly, what can move across borders, what can settle outside traditional banking bottlenecks, and what can still function when trust in the normal system starts to weaken. That is why this moment is bigger than a headline. It suggests that digital assets are moving closer to the real plumbing of the global payment landscape. This is where the deeper shift begins. The traditional cross-border financial system is powerful, but it is not frictionless. International transfers can be slow, expensive, and dependent on multiple intermediaries. In calm times, that is inefficient. In tense times, it becomes a vulnerability. And in a fragmented world of sanctions, trade disputes, and energy competition, flexibility becomes strategic. Crypto emerged from exactly that kind of question. Could money exist in a borderless, digital, and independent form? And now that question is becoming practical. Now let's talk specifically about Bitcoin. Bitcoin offers something rare in the modern financial world: fixed scarcity. There will only ever be 21 million Bitcoin. No government can print more of it, and no central authority can suddenly expand the supply. Its issuance is programmed, and after each halving, new supply becomes even smaller. That is why many people see Bitcoin as digital monetary scarcity. In a world of expanding balance sheets and weakening purchasing power, scarcity becomes incredibly attractive. Bitcoin may be volatile, but its rules do not change. People often call Bitcoin a deflationary asset, but the better term is scarce and disinflationary. New Bitcoin is still created through mining, but the rate of new supply keeps shrinking over time. That gives Bitcoin a radically different profile from fiat currencies. Most national currencies are inflationary by design. Bitcoin moves in the opposite direction. That is why, in times of uncertainty, Bitcoin becomes more than a chart. It becomes a statement. A statement that there is another monetary model, another financial architecture, another way to store value. But here is the key distinction. Payments and store of value are not the same thing. Bitcoin may increasingly represent the scarce, reserve-like asset in the digital world. Meanwhile, other digital assets may handle more of the day-to-day settlement and transactional flow. That includes stablecoins, tokenized value, and payment-focused infrastructure. And that does not weaken the crypto story. It strengthens it. Because it means the crypto economy is maturing into different roles. One layer for scarcity, one layer for liquidity, one layer for infrastructure. So even if Bitcoin is not the final rail for every transaction, its role becomes even more powerful. It becomes digital hard money in an increasingly digital world. For a long time, crypto was mostly viewed through one lens: price. Is it up? Is it down? Is this a bull market? Is this a bubble? But what happens when crypto starts appearing in discussions about energy routes, sanctions, and global trade resilience? Then it is no longer only about price. Then it becomes part of a much bigger shift in how the world thinks about money. Digital assets are moving closer to the real mechanics of global trade and global power. They are no longer just orbiting the system, they are beginning to touch the system. And once that happens, perception changes permanently. So what does all of this mean for the crypto market? First, it means volatility. Geopolitical stress does not guarantee instant upside for Bitcoin. Short-term, these events can create fear, tighter liquidity, and violent moves in both directions. Second, it means legitimacy. Every time crypto appears in a real-world payment or trade context, it becomes harder to dismiss. It gains weight, it gains relevance, it gains seriousness. Third, it points toward long-term revaluation. Because once digital assets are seen as real financial tools, valuation frameworks begin to evolve. Investors stop asking only how high something can pump. They begin asking what role it could play in the architecture of the future. And that is a much bigger question. So the deeper story is not simply Iran, conflict, and Bitcoin. The deeper story is that under pressure, the world begins testing new forms of money. Whenever a geopolitical conflict, an energy choke point, and crypto appear in the same conversation, that is not random. That is a sign of transition. Bitcoin represents more than a coin in this environment. It represents monetary scarcity in an age of uncertainty. It represents a system with fixed rules in a world of shifting rules. It represents the possibility that value can exist outside traditional structures and still matter globally. Whether you are bullish, cautious, or simply observing, one thing is becoming harder to ignore. Crypto is moving closer to the center of the world economy, and once that process begins, it rarely moves backward. If you want to understand not just where the market is moving, but why the world is moving this way, subscribe to the channel. Because the biggest changes usually begin long before most people realize what they are looking at.